Hey everyone, welcome back to Corporate Decoder. Today, Fidelity Newbury Street Trust TTICKE. Fidelity just filed its Semi-Annual Shareholder Report for April 2026, and I'm seeing some really interesting shifts in how they're parking their cash. Quick note, this is not financial advice. Just my take on public filings for educational purposes. We're going to dive into the Treasury Money Market Fund and the Tax-Exempt Money Market Fund to see where the money is flowing and what that tells us about the market. Alright, let's start with the Fidelity Treasury Money Market Fund. This fund is all about investing in short-term US Treasury obligations and repurchase agreements, aiming to keep your capital safe while giving you a little bit of income. Looking at their investments as of the 30th of April 2026, a huge chunk, 45.8%, is in repurchase agreements. Now, what is a repurchase agreement or repo? Think of it as a short-term loan where one party sells a security to another party with an agreement to buy it back at a slightly higher price. It is a very common way for money market funds to earn income and manage their daily cash needs. They're essentially getting paid to lend out their cash for a very short period, usually overnight, and they get us treasury bonds or similar safe assets as collateral. Then we have us treasury obligations making up 56.1% of the fund's net assets. This is pretty straightforward, holding us treasury bills, notes, and bonds directly. It is the bedrock of a money market fund focused on treasuries. The total value here is massive. For repurchase agreements alone, the cost is over $21.5 billion. That gives you a sense of the scale of this fund. Under the US Treasury obligations, we see a lot of T-bills, which are short-term debt issued by the US government. They're maturing at various points, with many listed around May and June of 2026. For instance, there is a substantial holding of US Treasury bills maturing on May 14, 26. With a principal amount over $1 billion. Looking at the overall financial picture for the Treasury Money Market Fund, the total assets are nearly $48.7 billion. Liabilities are around $1.6 billion, leaving net assets at almost $47.1 billion. This is a very stable, very large fund. Total accumulated earnings, a tiny positive number, showing that the fund is designed to preserve capital primarily, with income being secondary. And as expected for a money market fund, the net asset value per S-hair across all the different classes is exactly $1. The goal is stability of principal. For the 6 months ending the 30th of April 2026, the fund earned over $871 million in interest income. Expenses are managed quite tightly, totaling about $108 million before reductions, and then around $107 million after reductions. This results in net investment income of about $764 million. Now, let's look at the financial highlights for the capital reserves class. The total return for the 6 months was 1.43%. This might not sound like much, but for a money market fund, that is a solid return, especially considering the primary goal is safety. The expense ratio for this class, net of any fee waivers, is 0.95%. This is important to watch because even small percentages on large sums of money add up. Let's switch gears to the Fidelity Tax-Exempt Money Market Fund. This fund is similar but focuses on municipal securities that are exempt from federal income tax, which is great for investors in higher tax brackets. Here, municipal securities make up 13.6% of the fund's assets. These are bonds issued by states, cities, and other local government entities. A significant portion, 33.6%, is in tender option bonds. These are a bit more complex, essentially. They allow investors to buy municipal bonds with a short-term maturity and a fixed rate. Even though the underlying municipal bond might be long-term and have a different structure, it is a way to get short-term liquidity with potentially higher yields. Another large chunk, 33.5%, is in variable rate demand notes or VRDNs. These are also short-term instruments where the interest rate can reset frequently and the holder has the right to demand payment at short intervals. They offer liquidity and can be quite safe if backed by strong liquidity providers. We also see 10.7% in commercial paper. This is short-term debt issued by corporations, but for a tax-exempt fund, it is likely referring to commercial paper issued by entities that can offer tax-exempt interest, or it is being used in a way that aligns with the fund's tax-exempt objective. Looking at the financial highlights for the premium class of the tax-exempt money market fund, the total return for the 6 months was 1.12%. Their expense ratio here is 0.30%. This is significantly lower than some other classes, reflecting the economies of scale for larger share classes. For the tax-exempt money market fund, total assets are over $4.1 billion. Liabilities are around $45 million, resulting in net assets of just over $4 billion. The accumulated earnings are a very small positive amount. again highlighting the focus on capital preservation and tax-exempt income generation. Now, let's check out the investments in affiliated funds. The Fidelity Tax-Free Cash Central Fund is one such investment, with a value of over $341 million at the end of the period. This is an internal fund used for cash management. Overall, the funds are almost entirely invested in securities, with just a small portion in net other assets or liabilities. This shows a very high deployment of capital into investment instruments. The notes to the financial statements tell us that Fidelity Treasury Money Market Fund and Fidelity Tax-Exempt Money Market Fund are part of the Fidelity Newbury Street Trust. Each fund has different classes of shares like Capital Reserves, Daily Money, and Advisor C Class, each with slightly different features and fees. The Treasury Money Market Fund has 4 classes, and the Tax-Exempt Money Market Fund also has 4 classes available. The investment advisor, Fidelity Management FIDELITY Research Company LLC, charges a management fee, which is a percentage of the average net assets for the Treasury Money Market Fund. The management fee is 0.25% annually. For the Tax-Exempt Money Market Fund, it varies by class, but generally also stays quite low. Then there are distribution and service plan fees. These are paid to Fidelity Distributors Company LLC, an affiliate for selling shares and providing shareholder support. The Advisor C class of the Treasury Money Market Fund has a higher distribution fee of 0.75% plus a 0.25% service fee. So when you combine them, it is a full percentage point going towards distribution and service. The Advisor C class also has a contingent deferred sales charge applied when you redeem shares. For Treasury Money Market Advisor C class, it is 1% if redeemed within a certain period. This is a way to incentivize longer-term holding. Interestingly, the investment advisor has agreed to reimburse certain classes of both funds if their annual operating expenses exceed specific limits. For example, the Capital Reserves class of the Treasury Money Market Fund has its expenses capped at 0.95%, and the advisor reimburses if they go over that. This is a common practice to keep costs down for investors. Both funds made substantial distributions to shareholders. The Treasury Money Market Fund distributed over $764 million in 6 months, and the Tax-Exempt Money Market Fund distributed over $43 million. This income is generated from the interest and dividends earned on the fund's investments. Looking at the share transactions, the Treasury Money Market Fund saw a net increase of over $2.7 billion in shares for its main class during the 6 months ending the 30th of April, 2026. This indicates strong investor inflows into this fund. On the tax-exempt side, the premium class saw a net increase of about $245 million. This means investors are also putting more money into tax-advantaged money market funds, likely seeking yield in a stable, tax-efficient way. Enroll total investment in securities. 99.8% scroll, the overall picture is that these funds are highly invested, with their assets primarily tied up in repurchase agreements, US Treasury obligations, municipal securities, and other high-quality short-term instruments. The focus is clearly on capital preservation and generating income. With very low expense ratios, it shows a very conservative approach. What this tells me is that during this period, investors were seeking the safety and relative stability offered by money market funds, particularly those focused on US government debt and tax-exempt municipal bonds. The significant inflows suggest a cautious market sentiment, where capital preservation takes precedence over aggressive growth. The low expense ratios and expense limitations actively managed by Fidelity are standard practices aimed at benefiting investors directly. That is my take. Stay decoded. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. Like, comment, subscribe, and join our Discord.